The announcement by Donald Trump of an additional 100% tariff on Chinese goods layered on top of the existing 30% marks one of the most aggressive escalations in the long-running US-China trade conflict. This move effectively reviews a trade war that had only recently been dialed down through fragile agreements and temporary truces. At its core, the decision reflects a deep structural conflict between the world's two largest economies, one that goes far beyond trade balances and customs duties and instead touches technology, geopolitics, and industrial power, as well as long-term strategic dominance. Trade wars are rarely about trade alone, and this episode is no exception. The immediate trigger for Trump's announcement was China's tightening of export controls on rare earth minerals, a group of elements essential to modern manufacturing and advanced technology. Rare earths are used in semiconductors, electric vehicles, wind turbines, consumer electronics, and a wide range of military applications, from missile guidance systems to radar, and from communication equipment to helicopters. China's dominance in this sector is overwhelming, controlling the majority of global production and processing capacities. By restricting exports, Beijing signaled that it is willing to weaponize supply chain in response to US pressure, transforming economic interdependence into strategic leverage. From the American perspective, this was interpreted as a direct threat to national security and industrial resilience. The United States has spent years warning about over-reliance on Chinese inputs and particularly in critical technologies. Trump's tariff escalation is therefore framed not merely as a retaliation but as an attempt to force a structural decoupling, or at least to coerce China into relaxing its controls. However, tariffs of this magnitude function less as negotiation tools, more like blunt instruments. At a combined rate of 130%, many Chinese goods become economically unviable in the US market, amounting to a de facto embargo on large-scale segments of bilateral trade. Financial markets reacted swiftly and navigated to this announcement, reflecting the depth of investor anxiety surrounding renewed trade conflict. Major US indices fell sharply, with technology stocks suffering the most severe losses. This reaction is rooted in the reality that global supply chains remain deeply integrated despite years of rhetoric about reshoring and diversification. American technology firms, retailers, and manufacturers continue to rely heavily on Chinese product networks, either directly or indirectly. Tariffs disrupt these networks, increase input costs, and compress profit margin, all of which are immediately reflected in equity valuations. Beyond markets, the broader macroeconomic consequences are significant. Tariffs are in practice a tax on import, and those taxes are often passed on to consumers in one form of higher prices. In an environment where inflation has already been a major political and economic concern, a new wave of tariff-induced prices pressure risks, undermining economic stability. Consumer goods such as electronics, clothing, and household furniture, which constitute a large share of Chinese exports to the United States, are particularly sensitive to such measures. The result is a redistribution of costs away from foreign producers and towards domestic consumers and firms, a reality that complicates the political narrative of tariffs as a painless tool of economic nationalism. Historically, the US-China trade war has followed a cyclical pattern of escalation: market backlash, market backlash, partial de-escalation, and renewed tension. During Trump's first visit, tariffs climbed steadily between 2018 and 2019, eventually covering hundreds of billions of dollars worth of goods. While both governments claimed victory at various stages, empirical evidence suggested that the economic burden was widely shared, with disruption felt across global trade flows. In early 2025, a similar pattern emerged when tariffs briefly reached levels as high as 145% before being rolled back as a part of a negotiated truce. The current escalation suggested that those agreements address symptoms rather than underlying causes. One of the most important structural factors driving this conflict is the shifting balance of technological powers. China's industrial policy, often summarized under initiatives such as Made in China 2025, aims to move the country up the value chain and reduce dependency on foreign technology. The United States, in turn, has sought to slow or redirect this ascent through export controls, investment restrictions, and now renewed tariff pressure. The confrontation over rare earths highlights the asymmetry of this struggle. While the US dominates key areas of software, finance, high-end chip design, China retains leverage over physical inputs that are difficult to substitute in the short term. The political context is often equally critical. Trump's tariffs announcement must be understood within the framework of domestic US politics, where toughness on China remains one of the most bipartisan positions. Trade policy, particularly when framed as protecting American workers and national security, plays well with key segments of the electorate. At the same time, Trump's authority to impose tariffs unilaterally faces potential constraint from the judicial system, with pending legal challenges that could limit executive power in this domain. This creates an incentive to act decisively while such authority remains intact, even at a cost of increased economic volatility. On the Chinese side, the calculus is different. President Xi Jinping operates with a political system that allows for longer strategic planning and fewer indis- institutional constraints on executive action. Beijing has demonstrated a willingness to absorb short-term economic pain in pursuit of long-term objectives, particularly where issues of sovereignty, technological autonomy, and global influence are concerned. Retaliation may therefore take forms that go beyond tariffs, include further global exports, regulatory pressure on US firms operating in China, and measures targeting logistics and shipping. At the global level, renewed US-China trade hostilities accelerate a process of economic fragmentation that has been underway for years. Countries in Southeast Asia and South Asia and Latin America may benefit in medium term as risks seek alternative manufacturing bases to avoid tariffs and geopolitical risks. Vietnam, India, Mexico have already seen increased foreign investment as part of diversification trend. However, such transitions are costly and slow, and they do not eliminate the systematic inefficiencies introduced by politicized trade. The global economy, now less integrated, less efficient, and more prone to shocks. The implications for for international institutions and norms are also profound. The use of tariffs and exports control as strategic weapons undermine the multilateral trade framework around the World Trade Organization. When the largest economies act unilaterally, smaller states are forced to navigate an increasingly unstable environment, often pressured to align with one bloc or another. This dynamic resembles a form of economic cold war in which supply chains, standards, and technologies become instruments of geopolitical competition rather than neutral channels of exchange. In the long run, the revival of US-China trade war raises a fundamental question about the sustainability of existing global economic order. Interdependence, once seen as stabilizing force that reduces the likelihood of conflict, is increasingly viewed as a vulnerability. Both Washington and Beijing are recalibrating their strategies to reduce exposure to the other, even if that means accepting higher costs and lower efficiency. Whether this shift leads to a more resilient system or a more fragmented and unstable one remains uncertain. Ultimately, Trump's decision to impose 130% tariff on Chinese goods is not an isolated policy choice, but a symptom of deeper structural tension between two competing models of economic and political organization. It reflects a world in which economic policy is inseparable from national security, where markets react instantly to political signals, where boundary between cooperation and confrontation glows even thinner. As a countdown of implementation begins, the global economy faces another period of heightened uncertainty with consequences that will extend far beyond bilateral trade statistics into the very architecture of global power.